Waveline, presented by Ocean Lending. Thanks for tuning into the Waveline. I'm James Edwards, CEO at Ocean Lending. I'm here with Evan Deloach, Sales Manager. Evan, thank you for joining me once again today. Today, I think we want to talk about self-employment.
Absolutely.
I think there's a lot of different nuances and different ways that you can get a self-employed person qualified for a home loan, things that they need to know prior to them, entering into the mortgage application.
Yeah, absolutely. It can be a little bit different than if you're a W-2 employee. Obviously, your income's not going to be quite as stable. You may have months where you make a lot, and you may have months that are a bit down. So it's a little bit of a different process when it comes to underwriting these.
Right, and if you are just calling some guy that just got into loans, he might not understand how to dissect or even digest your tax returns. That could be problematic to you as far as, not giving you the full amount of the income that you are going to qualify for, or adding back into certain, depreciation or different things into your income that may mean making or breaking you as far as qualifications.
Of course. And what the main difference is between somebody who may be more experienced and less experienced is you're going to have two separate sets of guidelines here that you're abiding by as a business owner. You're going to have the IRS rules and regulations, which comes in the form of the tax code. It allows you to write off some expenses, reduce your taxable income. But when it comes to getting a mortgage, some of these items actually can be added back. So your income with your taxes and your income on your mortgage application, the 1003, may look a little bit different, and we can sometimes do better than what you show on your tax return.
Right, and then there's different types of self-employment too. So you got, the freelance, LLC, S Corp, C Corp. People need to know how to handle those in different ways that they're treated when underwriting them as well. And it can be complicated at times, can't it?
It can be complicated, mainly due to the fact that you're going to have less stability than somebody who collects the same paycheck every 2 weeks. And you have a business owner who has ebbs and flows as the markets change. If you're a gig worker, you might be putting a lot of time in certain months, and in other months, you may take a back seat to do other things, deal with family. And over the course of a 2-year window, that's how they're going to determine your income. That's the gist of how anybody who's self-employed, whether you own a business, a store, an online marketplace, or if you're a gig worker like a DoorDasher or an Amazon driver or anything like that, you're going to be treated to the same 2-year average across the board.
And not to make things more difficult, but some people could actually be a wage earner, plus they have a seasonal gig, so they have the Schedule C that they file, and you have a hybrid of income as well. And then with a W-2 income by itself, you might not qualify, but then if you add just that seasonal income, as long as you got most of the time a 2-year history, right? And that's something else we probably need to talk about. Then that might mean the making or breaking you of getting approved. Self-employed returns are never just cut and dry, is what it appears to be.
Not in my experience.
Right.
And if you have an experienced loan officer, a good lending team, they're going to recognize that you have multiple forms of income. You may need a little bit more documentation, but if that means you can afford more house or you can afford a better payment, then that's going to be the way to go. So you got to have a trusted partner. If you've got any kind of complicated tax returns, or if you have multiple jobs, you got to have someone that knows how these guidelines work and how they relate to being self-employed versus a typical wage earner.
Yeah, there's a lot of different programs out there. So, maybe you can qualify off of 1 year versus 2-year self-employment income. Depends on which agency you're going with. But sometimes people have, and let me ask you this question. They might have a lot of income, 2 years ago. Then last year they had less income. How do they calculate that?
So that's something very common right now, because we had a big downturn last year with a lot of businesses. You're going to see that you may have what they call declining income. 2019 was great. 2020 was a real tough year. And what they're going to do is they're not going to kick you out the door and say it's not going to be approved. You can still be approved, but normally they'll cut it down from the 2-year average to the 1 year to capture that lower year instead. So you got to be careful if you look over your tax returns to see which direction you're headed, whether it's inclining or declining.
And a lot of times a client might get purely surprised when you start asking them, hey, I need a profit and loss. They go, oh, why do you need that? They're going to look at that you're still making money even though you haven't filed actual returns, correct?
Absolutely. And part of underwriting, what they determine on most of these loans is this income stable, number one, and number two, is it going to continue? Normally, underwriters want to have reasonable confidence that you're going to have at least 3 years of continuance on income. And if you're showing strong income from last year, and the profit and loss backs it up that this year you're on track to do the same or better, that's going to give the underwriter the confidence they need to approve your loan.
So if somebody has a wage earner type of a position and then they're going into self-employment, then that's when they need 2 years of stable income, right? In the same type of industry, correct?
So yes, you're going to need at least 2 years in the same industry. If you work in an industry for a business and you're a wage earner and you decide to go take a swing on your own and you're going to go start your own business and you're successful at it, they'll typically take a 1 year look back at your tax returns of being self-employed and account for your 2 years plus of history in that industry. That gives an underwriter stability, and that gives them the ammunition they need to be able to approve your loan.
But isn't the weird part how if you're going in the opposite direction,
yeah,
then you only need 6 months on the job.
Sure.
If you had the 2 years in the industry previously, so you can be self-employed for 2 years, then you can jump into a W-2 job, and then 6 months. Sometimes they'll even do it with the first pay stub, and you get an offer letter from the employer.
Yeah, and what underwriters are doing there, they're looking at the overall stability of the income. Is this going to continue? And in being in business on your own, it's a tough game out there. You're sometimes going to have months where you do really well, and you may have down months where you got to reinvest and re-strategize. When you move over to a salary position, for example, you know what that check's going to be every 2 weeks, and so does underwriting. So that gives them more confidence that you're going to be able to make that payment.
Now, there is a type of self-employment that doesn't need a 2-year history, and that is real estate investors, right? So if I purchase a property and it's an investment property, I get to use that income right away, right?
Right.
And what type of documentation do they generally need so that I could use that income right away?
So you're probably going to need something along the lines of a lease agreement. They're going to want to see proof that you've got a tenant in there, that you do have somebody who's paying rent, and you're going to be cash flow positive on that investment property.
And then you get to use it right away from day one.
Right. They sometimes will cut it down if you have a shorter history of receiving that income. So you may be looking at 75% of the value of that, but not having a 2-year history on that is a big win for people who recently purchased investment properties.
And it just comes down to knowing your guidelines. If you know what you have to work with and your borrowers are upfront and honest with you, then usually you can put them in a situation to where they can be successful as well.
Absolutely. And when you're setting up the investment property purchase initially, these are the things that a seasoned loan officer would explain to a client who's looking to maybe expand their portfolio, maybe qualify for more properties in the future. And if you set these up correctly with the right expectations for what's reasonable to purchase in the future, they'll have an easier time expanding their portfolio, driving up their investments, and it'll make for a happy client.
For more information, please reach out to us at www.oceanlending.com.